Welcome to my channel. I'm the cover call guy, and my goal is to create $120,000 per year passive income using only cover call ETFs. My portfolio currently yields about $70,000 a year and about $6,000 a month. Legal disclaimer before we start this fun video today. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I am just some random idiot you found online, and I could be completely wrong. Now, with that out the way, let's get started on today's video on how to supercharge your financial independence. Again, this video is for you, and I'll let you know in the next slide why. I came up with these 5 high yield stocks with minimal to no price decay. How did I come up with only these 5? 1, the requirement was at least 15% yield, and 2, it had to have minimal to no price decay year to date as of today, November 24, 2025, which the video is going to be put out. So that I can only find 5. If I'm wrong, let me know in the comments if I'm missing. So 1, it had to at least a 15% yield or greater, and number 2, minimal to no price decay. So those 2 factors was the most important. I didn't care about anything else. I didn't care if it was a funds of funds, if it was leverage, if it was single stock, or however it holds, right? So whatever funds it come from. All right, let's get started. Why this video is for you and not me? Because these are the top 5 picks I would pick right now if I was at least 40 to 50 plus. I'm in my early 30s, so I have some planning and some foundation to build. If I was 40, 45, 50 or older, right? If I had kids, for the most part, I'm assuming in general terms, they would be at least 18 years old, right? So I wouldn't have to worry too much about them. I wouldn't have to worry if, this went wrong and they're 15 years old, 14 years old, they can't get a job, or we'll be homeless. So, yeah, if I was at least 40 plus, more for the good chance, if I was 40, depending on when I had the kid, right, they would either be 18 or close to 18. And then, of course, 50 plus, I'm assuming, depending on how many kids you have, at least 2 kids, 3 kids, they would at least all be 18 plus. So that's why, oh, did I do a disclosure here? I only own MAGY out of the 5. MAGY is currently a $40,000 position in my portfolio. I intend to build it out to at least 150 to 175. At the moment, I am investing on all my earnings, active and what my payouts from my portfolio into MAGY. So a minimum of I invest anywhere from $2,000 to upwards of $15,000 a month into MAGY. I should have it if everything goes well. I should have it fully built out by end of 2026 or early, or it should be earlier because it's already a $40,000 position as of November 24, 2025, and I'm trying to reach at least 150 to 175, depending on where the price is, and I'm trying to have it paid me $1,000 a week, so you guys can do the math here for me, anywhere from 150 to 175. Okay, before I get sidetracked, right? Scenario 1, I'm using 500,000 because I think 500,000 would really realistically already put you in retirement, or even less at 300,000. But I'm using 500,000 as a good number, as a round number. At $100,000 allocation into each would pay me $285,000 a year, about almost 24 grand a month. And since my portfolio is coming up on 1 million, I used a 1 million total invested. Also, about 200,000 allocation into each, almost 600 grand a year, about almost 50 grand a month. And then I asked myself, would I even be able to spend that type of money? And I almost said no, but I would be lying to myself, because at 50 grand a month, I like nice things. I don't need more than 1 car, but I'll probably have 10 if I made 50 grand a month. Just because at 50 grand a month, I might just spoil myself for a little bit and buy dumb things, right? And save $500 a month for ramen. Right, even at 23 grand a month, I don't need more than one car, but I'll probably have three, and I'll just put aside $750 a month for ramen. Right, live like a bum that entire month. But yeah, damn, the things I would do. Let me know what you guys would buy if you were making this type of money per month. Holy shit. I'll be there one day. I'll be there one day. Well, we'll all be there one day. Right? All my subscribers, all my viewers, all my anybody that leaves comments, support. We'll all be here within the next 3 to 5 years. All right, all of us, and we'll all be here within the next 10 years. All right, believe. We'll all get there. Alrighty. All right, top 5 high yields with no price decay, right? So we're going to go through the typical old Gen 1 and kind of Gen 2 ETFs. All right, they have the income dilemma, which is the constraint. Investors historically face the yield trap. Safety means accepting 2 to 3% yield, useless for fire. High yield meant buying distressed assets or capped cover calls that guaranteed price erosion over time. One that I mention a lot on this channel is QYOD, for example. And then a structural solution, right? These Gen 2, Gen 3 ETFs utilize structural alpha, which just means engineering upside participation directly into the fund's mechanics. They deliver 36 to 100 over 100% yields while maintaining the mathematical ability to grow NAV. And this is strictly talking about the 5 ETFs. I'm not talking about any other ETFs today, just the 5 that I mentioned in this video, in this slide. All right, so um, the lowest is 36%, which is MAGY, with TSII over 100% yield. All right, and then the yield shield, what that just means is mechanisms like daily leverage and asset decoupling effectively shield your principal, allowing you to live off cash flow without selling shares. And I'll break it down which one is leverage and which one is decoupling. All right, the mechanism of no price decay, right? High yield, high risk, high reward is why I, in my 30s, trying to build my portfolio, a family, and everything else, I really can't go down this route. But however, if I was much older, then yes, I would have no worries about, my kids. They're all 18 plus, go and do their own thing, right? They would be my retirement plan if this failed, right? So to speak. Or I might just work a dead end job and live with one of the kids. Anyways, leverage, right? So TSII and VII would be the leverage at 1.5x. These would be my growth engine. By holding 150% exposure and only capping 100%, 50% of the portfolio is effectively naked long. This uncapped tranche drives NAV growth in bull markets. And then I might have my decoupling, right? So it's just a speculative asset class. It will be my MAXI. No cannibalization. The yield is derived from a totally different asset class, equity spreads, than the core holding Bitcoin. Ensuring principal asset is never sold to paid income. And then I have my out of the money discipline, right? So the profit zone, MAGY CHPY deliberately sells calls out of the money, ensures the fund captures stock price appreciation before cap kicks in, preventing flatlining. So this would help with my NAV stabilization. Because remember, leverage, as much as it can go up, it can also go down. The leverage growth engine, which is from Rex Funds, is my Tesla and my NVIDIA, TSII, and VII. The 1.5x asymmetry. Legacy funds hold 100% stock and sell 100% calls. If the stock rallies 5%, the fund is capped at 0 to 1%. The upside is lost, right? So with leverage, the solution is these two. It has 150% daily exposure, which means 100% is covered, generating yield, and 50% is uncovered, generating growth. The mathematical growth behind it, and a 2% daily rally, the covered portion stays flat. The yield is collected, right, the premium, and the uncovered position, the portion raises 2%. Net result, fund NAV rises 1% plus the yield. This structural net long delta is why NVII is up 47% since inception, despite paying 50% plus yield. So it's been an absolute monster. Rex shares evidence of success. What this means, it just right now we're seeing real time evidence that it's working, right? So historical evidence where we're seeing since inception that it has grown 47%. The NAV has grown, right? So even with the payout, the principal grew. Right? Skeptics often claim high yield fund must decay to zero, which is untrue. The proof is the empirical data showing the share price, which is NAV rising along distributions. This validates that the 1.5x leverage structure is successfully generating enough growth to cover the dividend and grow the principal. It is not just a theory, it's happening, right? So that's why it got picked. NAV rose about 30. TSSI and NAV rose about 30%. So these two are doing very, very well for a leverage position. The decoup yield generator, right? So it's decoup. The decouped yield generator just means that it's decouped from a traditional asset class. It is the MAXI from Bitcoin. The separation thesis: most yield on crypto products sell calls on crypto itself. If Bitcoin moons, you lose your coins. That is a failed strategy for long-term holders. Maxi's innovation, it separates the two engines. Engine A is long Bitcoin futures for growth, and Engine B, short equity slash bond spreads for yield. And it also has an additive income because the income comes from FC 500 or Treasury market. It is an additive to Bitcoin return. It does not cap your Bitcoin upside. You get 100% of the Bitcoin rally minus fees, plus the monthly coupon from the option strategy. This is a definition of structural alpha. So it's kind of getting kind of the premiums from everywhere as much as possible, right? So it's just feeding into um, the maxi yield, which is why it has not had any price decay. Maxi advantage and validation, right? So strategic diversification by sourcing yield from equity bond volatility. Maxi diversifies your risk. Equity volatility spikes often, do not correlate perfectly with crypto crashes. And the tax advantage of this is that Maxi is structured as a C corp to block ECI, effectively connected income, and K1s. You simply get 1099 tax reporting, unlike many crypto future strategies. And I've dealt with K1s before. If you're just growing your, your portfolio, but if you're kind of in my situation where I own pretty much a decent amount of stocks, I have real estate, and I have a side business, so I do have a personal account to deal with K1s. K1 is a bit annoying and tedious. I've tried to do it on my own before, but it was just a headache. So I've hired an accountant, and I have when you get to that point, you should also, my opinion, have a personal attorney just for legal stuff, which I have. So it just helps with headaches, and you get to ask a lot of legal questions. Anyways, before I get more sidetracked, performance validation, proving that you can harvest high yields at 43% plus without eroding the underlying growth engine. The decouping works. So Maxi was my choice over BTCI just because of the higher yield. Plus, of course, no price decay, which right now BTCI is having some price. I wouldn't say price decay. All right, we don't want to get that mixed up. It's not. There's no NAV erosion with BTCI. I want to get that out there before I get comments saying, oh, BTCI is not NAV erosion. What I mean by price decay is that right now it's still up, not NAV decay, but it's doing better compared to BTCI just because BTCI is more correlated with Bitcoin, the underlying. It has no NAV erosion, so I just want to get that out there. All right, so NAV Maxi NAV rise since inception plus 71%. So no hate with BTCI, but this Maxi was a better pick and a higher yield. Why out of the money matters. The good of out of the money. Writing calls out of the money is the single most important factor for preserving NAV in non-leveraged funds. All right, upside capture. If you sell 5% out of the money call, the stock can rise 5% before you are capped. The fund keeps that 5% gain, giving you a buffer building. These accumulated gains build a NAV buffer that helps absorb future drawdowns. And then, of course, I got to mention the bad of at the money, the legacy cover call ETFs like QYLD. Legacy funds sell at the money calls, zero upside, full downside. The result, permanent NAV decay. All right, Maggie, my insider analysis, right? The synthetic advantage. Maggie just doesn't just hold stock. It typically uses synthetic replication or holds the MAG ETF, which it does currently right now, and write calls against it. The reason for this is the strike logic. Unlike systematic funds that mechanically sell 2% out of the money every month, MAGY active management targets specific delta levels. This allows them to widen the out of the money gap during earnings seasons, capturing the fat tail, which is basically the upside rallies that passive funds miss. Right, it has the ratcheting NAV. By capturing the first 3 to 5% of a rally, the NAV base increases. This higher base generates higher dollar value premiums in the future. And since inception, Maggie, I believe, I'm not saying this because I hold it and I'm biased, but right now I really do think Maggie is the best of the best for weekly ETFs. They have been very, very consistent on their payouts, anywhere from 34 to 38 cents, depending on obviously the market. Right, goes up, goes down, so you can kind of guess where it's going to pay you. But they have been very, very consistent. I think they are the best weekly payer of all weekly ETFs in their classification. Chippy, right? I think Chippy is one of the best um, performers for yield max, and I am kind of starting to warm up to Chippy, but because not hating here, all right, but because it is a yield max product, I'm a little bit cautious. It did get select, however, because one, high yield and no price decay, so it does fit my pick for this video. Let's get started. Chippy has Chippy basically gets rid of the single stock risk, right? The single stock semiconductor plays like Nvidia or prone to 20% drops on one bad earning call. Chippy eliminates this zero risk, right? It has the basket dampener. Chippy invests in 15 to 30 names. If AMD crashes, Broadcom may rally. This internal hedging smooths the NAV curve, right? Chippy harvests volatility. It is actively managed. When semi-volatility spikes, IV above 50, premiums explode. The manager can sell calls 10% out the money and still generate 40% annualized yield, creating a massive safety buffer that prevents funds that passive funds cannot match, and even other active funds cannot match. The yield shield explain. I was gonna put this on an earlier slide, but I feel like this is a better slide on its own. Sequence of return risk, right? The number one killer of retirement portfolio is having to sell shares when the market is down. Once sold, those shares are gone forever and cannot participate in the recovery. We don't have that problem, right? We have the solution. With yields of 40 to 100%, these funds generate enough cash to cover all withdrawals. You never sell single shares. Your shares count remain intact, acting as a shield. That is the yield shield that preserves your capital base for the inevitable market rebound. And of course, we got to talk about tax efficiency and income velocity. Right now, I believe all of them are constructive rock. My verdict is yes, these funds typically utilize constructive return on capital. The mechanism behind that is they often have unrealized gains on the stock positions, but realized losses on the option hedges. These paper losses offset the income for tax purposes. You get cash flow now, but pay taxes later, which is deferred when you sell the ETF, drastically lowering your current tax bill. Principal preservation, right? Why these picks? Income velocity is the speed at which capital flows back to you. With yields above 50%, you recover your entire initial investment in 2 years via dividends or option income. Even if the price drops, your risk is removed quickly because they generate excess yield above which withdrawal needs. You can reinvest the surplus to grow your share count mathematically, forcing principal growth. Of course, a lot of this is, of course, hypothetical, right? Within that 2 years, a lot of things can happen. All right, and this is just my grading strategic shortlist analysis. I give a TSII an A, NVII an A minus. Maggie, of course, no bias here, and I really believe it's an A plus, if not A. I think it's the best of its best in its weekly ETF class. I give Chippy an A minus and a Maxi a B plus. Let me know if you agree. Let me know if you disagree on this because I really don't think I'm being biased here, but this is just my rating grade. So for those who own TSII, MVII, Chippy, and Maxi, was I fair? Was I unfair? For those who own Maggie like I do, was I fair, unfair? I think Maggie deserves an A plus. That's just me. I'm unbiased, unbiased, no bias here. This channel is all about transparency. It's all about honesty. Um, I don't ever delete. As you can go back to all my videos, I don't ever delete comments. I try to respond to everybody. Love, hate, I respond to everybody. Right? Okay, I did delete comments, but they were pure spam. They were trying to scam people, the typical bots. All right, my verdict. If you have higher risk tolerance, these high yield picks are uniquely engineered to monetize volatility by leveraging structural alpha to combat decay. They offer a powerful, aggressive tool set that can, if managed correctly, supercharge your financial independence. All in, no risk, no glory, right? So right now, since I am in my early 30s and I'm trying to build myself up to a solid foundation and hopefully have a family of 5, I don't have that higher risk tolerance now. But if these 5 stocks continue to perform like they're performing and can hold my criteria of 15% yield and minimal to no price decay, I will be buying them. Probably in my 40s to 50s, I will be start switching over to these. If you're in the age group and you hold these, is it a bad pick? Is it good picks? Let me know. If you're 40s plus, was this a good video? Did it make sense? Did it not make sense? Are you kind of engineering your portfolio to these type of stocks, or you're going the more, or you're still going? You know what? Y- your portfolio mirrors mine, a little bit more safer and stable and lower yields. Let me know. Please leave a comment. It gives me an idea and understanding if I kind of guess correctly in a way. So join the movement and then by the movement I mean my comment section. Subscribe, like, let me know. I appreciate all love, hate. I try to respond to everybody. Let me know, what if you liked the video, if you didn't like it, if you want more type of these videos. I try to do a video request too. So if you got a question, you want a video about it, let me know. I appreciate you guys watching this video. Catch you guys in the next. Stay tuned.